In November 1923, in Berlin, a high school teacher named Friedrich Keller left home at 5 a.m. He wasn't going to teach. He was queuing outside a bakery. In his coat pocket was a wad of money so thick he had to tie a leather cord around it to keep it from falling. 3 days earlier, that money had been enough to buy food for his whole family for a week. That morning, it was only enough for 2 loaves of bread. The price of bread had doubled in just 48 hours. The German mark had lost more than 99% of its value in less than a year. People carried money in wheelbarrows. Children used banknotes as toys. Those who had saved their whole lives were suddenly penniless in a few months. Friedrich wasn't a speculator. He didn't take on risky loans. He didn't gamble on the stock market. He simply believed in one thing: the national currency was the store of value. And then that belief crumbled. It's noteworthy that Germany wasn't the only economy to experience this phenomenon. History has seen similar cycles in France in the late 18th century, Latin America in the 1980s, and Zimbabwe in the early 21st century. Each time, the surface story is different. But the underlying mechanisms share striking similarities. Currency doesn't collapse because of a single event. It collapses when the structure of power, debt, and trust intersects at a breaking point. And when that happens, the reconstruction process doesn't begin with policy, it begins with the redistribution of wealth. Friedrich's story isn't just the story of one man in 1923. It's a warning about how a monetary system can erode itself from within while outwardly appearing stable. We often think of currency collapses as a phenomenon of weak nations. But history shows the opposite. The biggest collapses often occur in systems that were once considered robust. And to understand why this happens repeatedly, we need to peel back the layers of illusion that society still believes in. In every currency crisis, the common narrative emerges very quickly. People say it's the fault of war, the fault of excessive public spending, the fault of central banks printing money, the fault of corruption, the fault of speculation. These explanations aren't entirely wrong. War creates huge budget deficits. Governments borrow to finance spending. Central banks expand their balance sheets. Inflation rises. The currency weakens. The chain of cause and effect seems simple and logical. But if that's all there is to it, why do countries with sophisticated financial systems, developed capital markets, and professional governance still gradually reach a breaking point? Why have currency collapses occurred not only in small economies, but also in major powers? The problem lies in the fact that modern currency is not just printed paper. It is a debt structure. In a fiat currency system, each unit of money is created through a corresponding debt. When the government issues bonds, when commercial banks extend credit, when the central bank buys assets, new money appears in the system. And simultaneously, the obligation to repay is also created. This creates an illusion of stability. When credit expands, assets appreciate. When assets appreciate, household and business balance sheets look healthier. When house prices, stocks, and bonds rise, society feels wealthier. But that feeling of wealth depends on one condition: interest rates must be low enough to maintain the ability to service debt. When the interest rate cycle reverses, the debt structure begins to reveal itself. Interest costs rise. Government budgets are choked by interest payment obligations. Businesses refinance under stricter conditions. Households face payment pressures. On the surface, there is still talk of GDP growth, the job market, and stock market indices. But at a deeper level, the system is shifting from a credit expansion phase to a contraction phase. History shows that the most dangerous times are not when inflation explodes immediately. The most dangerous situation arises when the system attempts to prolong an unsustainable debt structure by continuously creating new debt to pay off old debt. That's when currency begins to lose its long-term store of value. And as the belief that the government can always control the situation erodes, money begins to flow out. At this stage, the public often still believes that everything is just a temporary cycle. That inflation will cool down. That the central bank has the tools to handle it. That the market will self-correct. These beliefs have existed before many major crises in history. What makes monetary cycles dangerous is not that they are sudden, but that they occur slowly, slow enough for society to become accustomed to the erosion. And when the erosion becomes normalized, the real mechanism begins to operate. When looking deeply into the modern monetary structure, the first thing to understand is, this system operates on leverage. Money isn't just printed. It's multiplied through credit. Commercial banks lend based on deposits. The government spends more than it earns through bond issuance. The central bank intervenes in the market by buying financial assets. Each layer is stacked on top of the other, forming a debt pyramid. During periods of growth, this pyramid looks very stable. Expanded credit allows businesses to invest, households to buy homes, and the stock market to rise. Rising asset prices make collateral more valuable, thereby allowing for more borrowing. A positive feedback loop is formed. This mechanism is called the credit expansion feedback loop in economics. The problem begins when the rate of debt growth far exceeds the rate of real productivity growth. When the economy's real income fails to keep up with interest payment obligations, the system is forced to choose, either reduce leverage accepting a deep recession, or maintain leverage accepting inflation and currency devaluation. Herein lies the power dynamic. Politics rarely accepts a direct drop in asset prices. A sharp decline in the real estate or stock market affects not only wealthy investors. It drags down the banking system, pension funds, local budgets, and public confidence. Therefore, instead of letting the system naturally deflate, policy often leans toward supporting liquidity. Cutting interest rates. Expanding balance sheets. Extending debt. Refinancing. In the short term, these measures stabilize the surface. The market recovers. Stock indices rise. House prices stop falling. But in the long run, they shift risk from the private sector to the state's balance sheet. Private debt is socialized. The burden of interest payments shifts to the national budget. This is the key point. When the currency is protected by expanding public debt, the value of the currency becomes dependent on the belief that the government can service its debt obligations indefinitely. As the public debt to GDP ratio rises, interest expenses become the largest expenditure in the budget. Each time interest rates increase by 1 percentage point, the cost of servicing debt balloons exponentially. The system enters a state that economics calls fiscal dominance, where monetary policy is constrained by fiscal burdens. In this state, the central bank is no longer entirely free to prioritize price stability. Because maintaining high interest rates long enough can cause the government to lose control of the budget. The feedback loop reverses. To avoid a sovereign debt crisis, interest rates had to fall sooner than necessary to control inflation. As interest rates fell, credit was encouraged. Debt continued to rise. The cycle continued to be prolonged, but the foundations became increasingly fragile. At a deeper level, this process created a mechanism for redistributing wealth. As the currency depreciated, those who owned tangible assets, real estate, stocks, resources, often protected their relative value. Meanwhile, those holding cash, fixed savings, or income not adjusted for inflation suffered real losses. The shift in assets occurred silently, without formal declaration. That is how a monetary system can rebuild without changing the constitution or regime, simply through adjusting the real value of the currency. And when looking at modern indicators, familiar patterns begin to reappear. If we compare modern figures with pre-crisis periods in history, the picture becomes difficult to ignore. The public debt to GDP ratio in many major economies has surpassed levels once considered wartime exceptions. In some developed countries, this figure has hovered around or exceeded 100% of GDP for many consecutive years. What is noteworthy is not just the absolute amount, but the rate of increase after each shock: financial crises, pandemics, cyclical recessions. Government borrowing costs have risen sharply in a high interest rate environment. As long-term bond yields rise, budgets must allocate a larger proportion to interest payments instead of investing in infrastructure or social services. In some economies, borrowing costs have approached or exceeded defense spending, a signal that has appeared before periods of debt restructuring in history. In the household sector, total consumer debt and mortgage debt remain high relative to disposable income. Debt-to-income ratios tend to increase as interest rates adjust. Credit cards, auto loans, student loans all create a layer of financial obligations that spans many years. Meanwhile, financial asset valuations remain pegged at historically high levels. Stock market P/E ratios have at times far exceeded long-term averages. Real estate prices in many major cities have outpaced real wage growth for over a decade. The discrepancy between asset growth and real productivity growth raises a quiet question: is this gap sustained by real cash flow or by leverage? Looking back to the 1920s before the Great Depression, or the early 2000s before the global financial crisis, a similar pattern emerges: expanding credit, rising asset prices, and confidence in a new era of sustainable growth. Currently, global inflation has undergone a cycle of sharp increases followed by relative cooling. But overall prices remain significantly higher than before the shock. Nominal incomes have risen, but real incomes in many middle-class segments have only recovered slowly. At the same time, central banks' balance sheets remain much larger than they were before the 2008 financial crisis. The liquidity injected into the system in recent years has not completely receded. No single indicator is sufficient to conclude that a currency collapse is imminent. But when the pieces are put together, high debt, rising interest costs, overvalued assets, slow productivity growth. A familiar pattern emerges. History shows that the most risky times are not when all indicators deteriorate simultaneously, but when the system appears stable while underlying pressures build. And when that pressure spills over from the balance sheet into everyday life, the story is no longer about graphs or percentages. As currency depreciates over time, the first impact doesn't appear in the foreign exchange market. It appears in the kitchens of the middle class. The cost of living rises faster than real wages. Home prices are far beyond the reach of first-time buyers. Savings in banks yield lower returns than the general price increase for many years. The gap between asset prices and labor prices widens. For younger generations, the dream of home ownership is increasingly distant. They have to borrow for longer terms, make smaller down payments, and accept higher debt-to-income ratios than previous generations. The first asset in life is no longer the result of saving, but of leverage. At the family level, financial pressures change social behavior. Birth rates decline in many developed countries amid rising child-rearing costs and unstable incomes. Young people delay marriage. Many adults return to live with their parents for longer periods. Internal migration increases as workers leave urban areas with excessively high housing prices in search of lower living costs. This alters the local economic structure, creating polarization between regions. Meanwhile, those who owned property before the inflationary cycle often see the value of their assets increase over time. The wealth gap between the owning and non-owning groups widens. This is not just an economic issue, it's a psychological one. The feeling of being left behind creates simmering discontent. When society realizes that labor no longer guarantees accumulation, confidence in the system declines. Debates about property taxes, price controls, housing policy, and income redistribution become more intense. Money, in its deepest essence, is a social contract. It functions because people believe it will hold a relatively stable value and can be fairly exchanged for their labor. As currency erodes slowly, so does the social contract. There isn't a single moment when everyone simultaneously declares a loss of confidence. This loss of confidence is diffuse, manifested through small decisions, shifting money to other assets, demanding higher wages, withdrawing capital from weak banks, seeking opportunities elsewhere. At a certain point, these individual actions amplify into systemic pressure. And then, policymakers face a paradox. Defending the value of the currency may cause short-term pain, but delaying adjustment may deepen the pain later. In this dilemma, the system often doesn't choose the easy path. At this stage, the system is no longer in a normal state. It's stuck. High interest rates, if sustained long enough, can slow inflation, but they also inflate borrowing costs for both the government and the private sector. Businesses refinance under stricter conditions. The national budget must allocate a larger proportion to debt obligations. The real estate market stagnates. Growth weakens. Conversely, if interest rates are lowered too soon to support growth and protect the asset market, inflationary pressures could return. The currency is under pressure to depreciate. Capital flows seek other safe havens. Politics complicates this choice. Asset prices have become the cornerstone of modern social stability. Pension funds depend on the stock market. Local budgets depend on property taxes. Households rely on house prices to secure their future. A sharp drop in asset prices is not just an economic adjustment, it's a social shock. Therefore, the system often leans toward delay. Debt extensions instead of debt forgiveness. Refinancing instead of liquidation. Liquidity support instead of accepting chain bankruptcies. Bailout programs are designed to prevent immediate collapse. Each such decision prolongs the process. But at the same time, it reinforces a reality: the debt structure is growing larger, and the reliance on low interest rates is deepening. This is the systemic trap. When debt reaches a sufficiently large scale, a return to a hard monetary state becomes almost impossible without causing a deep recession. Once the market is accustomed to abundant liquidity, a liquidity withdrawal can cause panic. In that state, the currency doesn't collapse suddenly like an explosion. It may enter a prolonged period of real value erosion, where inflation is just high enough to reduce the debt burden over time, but not high enough to create hyperinflation immediately. Systemic reconstruction in many cases doesn't happen through an official declaration. It happens through the silent adjustment of money values and asset structures. Holders of fixed long-term debt suffer losses. Those capable of revaluing assets preserve their positions. The wealth distribution gap is being redrawn. And looking back at history, this pattern is not a rare exception. When modern cycles are juxtaposed with historical examples, a recurring pattern becomes increasingly clear. Before a currency collapse, there is always a prolonged period of expanding credit. Assets appreciate faster than income. Confidence in policy making is high. People believe the system has evolved past past mistakes. In the late 1920s in the US, stock leverage surged before the market crash. Before 2008, real estate credit expanded with the belief that house prices cannot fall on a broad scale. Before hyperinflation in many countries, governments believed they could control money issuance sophisticated enough to avoid uncontrolled devaluation. Each time, the logic sounds plausible in the short term. But the common signature of currency collapses is not simply inflation. It lies in the persistent imbalance between debt obligations and the capacity to create real value. When debt accumulates beyond the economy's growth capacity, the system is forced to rebalance. Rebalancing can occur through public defaults, formal restructuring, or through sustained inflation that diminishes the real value of debt obligations. In many cases, the third option is preferred because it causes less immediate shock. Inflation doesn't need a declaration. It doesn't need a vote. It happens gradually. Those who own flexible financial assets can adjust their positions. Those with fixed incomes or cash savings suffer silently. The wealth gap is redrawn over time. Notably, after each period of deep currency devaluation, a new system often emerges. New currency is issued. New price anchoring mechanisms are established. Fiscal rules change. Sometimes there is a change in the political regime. This reconstruction process is not just economic. It is a redefinition of ownership and social order. Looking at the present, there is no conclusive evidence that a major currency will collapse tomorrow. But structural conditions, high debt, dependence on liquidity, highly valued assets, political pressure create a prolonged state of vulnerability. History doesn't repeat itself down to the smallest detail, but it repeats the dynamic pattern. And that pattern always revolves around a core point: money only has value when society believes it will retain its value. When that belief is eroded long enough, the system no longer operates on pure arithmetic logic. It operates on collective psychology. Currency, therefore, is not just a tool of exchange. It is a mirror reflecting the stability of the entire power structure. If one day the mirror begins to crack, the question is not just how much value the money loses but what order will replace it. Currency, at its deepest level, is not printed paper, not numbers on bank screens, nor precious metals stored in reserves. It is a collective promise. A promise that today's labor can be converted into tomorrow's value. A promise that a lifetime's savings won't vanish because of a single policy decision. A promise that the system in which society lives has continuity. When a currency collapses, what is broken is not just purchasing power. What is broken is faith in the sustainability of the power structure. In every historical instance, collapse doesn't unfold like an instant disaster movie. It begins with small adjustments: a bailout package, an easing program, a new debt issuance, a delay in difficult reforms. Each individual decision has its own rationale. But when those decisions accumulate over the years, they create a structure dependent on the very continuous expansion of money and debt. At some point, the system must choose between two unacceptable options: allow asset prices to adjust sharply and accept a deep recession, or allow the value of the currency to adjust and accept the erosion of purchasing power. History shows that the second path is usually less shocking immediately. And precisely because it is less shocking, it is more readily accepted in the short term. But the long-term price is the silent shift in the wealth order. Those holding real assets weather the adjustment period. Those dependent on fixed wages or nominal savings gradually lose their position. The rich-poor structure is redrawn without the need for a public redistribution law. After each such cycle, a new system is formed. Sometimes a new currency. Sometimes a new price anchoring mechanism. Sometimes a stricter fiscal agreement. Sometimes it's a different political order. Reconstruction isn't a single event. It's a process of readjusting the relationship between money, power, and wealth. So the story of currency collapse isn't just the story of distant countries or turbulent periods of the past. It's the story of how a society chooses to allocate risk and protect interests during times of mounting pressure. Currency can be reprinted. Systems can be redesigned. But trust, once deeply damaged, takes years to recover. And that's the key point. Because when you look at a currency today, it's not just about the exchange rate or inflation. It's about the more fundamental question: does that society still believe the promise that the currency represents? As long as trust is maintained, the system can last for many more years. When trust begins to crumble, change often comes faster than any predictive model. And each generation, in its own way, must confront that moment, the moment of realizing that money is not just an economic tool, but the foundation of the entire social order. When that foundation is shaken, history always shifts accordingly.